Hello, I'm Finola Burke from RaaS Research Group. Today we're focusing on Pureprofile, ASX ticker PPL. Joining me to discuss the company's unaudited H1 FY26 results is CEO Martin Filz and COO CFO Melinda Sheppard. Welcome back, Martin and Mel.
Hey, Finola.
Thanks, Finola.
Martin, we'll start with you. Pureprofile's delivered record H1 revenue of 33.3 million, with platform contributing 9.4 million of the total, a jump of 54% on the PCP. Your investment in automated data delivery solutions and API integrations is clearly making a difference. Were you surprised at the uplift in platform revenue in the half, and what were the key drivers?
Great question, Finola. Yes, delighted with the overall results. One of the key cornerstones of our strategy was growing technology, and as we've talked about latterly, AI. Platform, I think 5.5 years ago, made up about 400K of our total revenue, and now, as you say, it's 9.4 million of 33 million. Where it's come from is we made the major release at the end of financial year 25 of Data Rubico. And Data Rubico is in effect made up of two parts. Automation. One part is clients using SaaS solutions, accessing data either directly or via creating DIY surveys. And the second element is automation, end-to-end automation of our platform. So I'm not surprised to see the growth. The majority of the growth has come from the automation of our end-to-end platform. This means the majority of growth has come from UK and US, where we've streamlined that automation. And then in Australia and Southeast Asia, the growth has come from clients who have either subscribed to the accessing data or accessing the survey creator solution. The majority of growth coming though from the automated platform. So absolutely part of our strategy, all lends to increasing margins and also giving us clients on scale.
And Martin, you highlighted in your presentation that revenue from Pureprofile's top 25 clients increased by almost double the rate of overall revenues. Are we seeing a step change in the way in which Pureprofile's larger customers are engaging with you?
Yeah, that's a really good question. I think it's a couple of things. One, absolutely. When you are a leader, as we are on quality and service and delivery, you're winning a greater share of wallet from your key clients. And those key clients being not now just in Australia, but around the world. So we're seeing, yes, it's an endorsement of our services and trust in the solution. The other thing that you're also seeing is the top 25 is growing as we expand in the US and the UK. So we're seeing now, I think it's something like 50% of the top 10 clients are now actually overseas, rest of the world clients versus coming from Australia. And those have gone through rapid growth. And so you're seeing the available wallet and the spend of the overseas clients being that much larger. And so that's why their spend is a lot greater. And then also we're adding new clients consistently. So I think last year we added 135 new clients. What happens with those new clients is they start off with a smaller share of wallet. And so you hit the maximum share of wallet that you'll get could be 100% if they're going to only have one supplier, could be 50% if they've got two, over 2 to 3 years. So what you then see is that lengthening of the tail, which therefore also sees a revenue increase or a share increase in the top 25. So you've got three things at play.
Mhm. And Mel, you increased your revenue guidance range to 64 to 65 million from 63 to 64 previously. And then you've also maintained the EBITDA margin range of 10 to 11%, which effectively is a small upgrade in EBITDA guidance. What gives you the confidence to increase guidance at this point in the year, and how much visibility do you have into the second half?
Yeah. Well, the decision to upgrade has really been driven by the half one results. So obviously, that was a great result for us at 14% growth. So we were thrilled with that. And then the sort of the balance of the year is based on the confidence of what we can already see. So we do talk about we've over the last 12 months we've had $14.1 million worth of annuity revenue. We have a good idea about our repeat business. We can see what's already contracted for the next quarter and the next half, and so that gives us a lot of confidence to upgrade at this point in time based on where we're sitting. We've recently done a reforecast for the business based on some of the new headcount we've brought in, and we know obviously what's our current team can deliver, and that just gives us a lot of extra confidence too. So we kind of look at it from lots of different angles, and then sort of form an opinion. But yeah, we feel really confident about where we're sitting going into the second half of the year, and we're nearly only 5 months left, really.
And Mel, with rest of the world now more than 50% of revenues, are there any additional strategies you're looking at employing for any potential currency management?
Yeah, I mean, that's a great question. I mean, and definitely, obviously, as the business has grown, we generate a lot more revenue in lots of other currencies, such as the euro, the British pound, US dollars, Singapore dollars, etc. But it's something that we've always monitored currency exposure for our business, and our overall approach hasn't really changed from what we've been doing over the last couple of years. We have a bit of a natural hedge because we do have a lot of revenue and costs in the same currency. We also have a couple of our larger supply contracts actually are quite flexible in the fact that they allow us to pay those suppliers in different currencies. So we make a call on that each month as to which currency we would choose to pay those costs in. And importantly, the other thing, we just monitor exchange rates. When the exchange rate's good and we've got some excess cash, we might convert and make a little bit of money on the side from currency upside. So that's something that we also look at as well. I mean, my team are they spend a lot of time looking at this, and we try and minimize any sort of currency risk that we have at the moment.
And Martin, as Mel called out, you recently started to talk about annuity revenue, which is now at 14.1 million for the rolling 12 months to December 31. What have been the key drivers for annuity revenue, and are there any notable clients adding to that pool?
Yeah, obviously we're all delighted with that, and it allows us, as to your last question, allows us to forecast the business much more. The annuity revenue comes from two key areas. It's either one, clients signing to our SaaS solutions, so it's a 12-month contract, monthly payments, and so that's long term. And the second one is actually long-term data and insights projects. These could be such things we call tracker type projects, but it's long-term repeatable work and repeatable contracts, and that's anywhere from 1 to 3 years. And so one is endorsement of our SaaS solutions, and the other one is endorsement of our quality of data, quality of services, so that somebody would give us long-term contracts. And the majority of growth actually has come from the long-term contracts. That's outweighing, and especially where you see that growth in the rest of the world, where the majority of that's coming from, that outweighs the sign-ups of the new SaaS solutions. Great to have both. I don't mind that one's being outweighed by the other, because both ends up to growth for us as a business. But they're the two areas that it comes from, and yeah, we're happy with both increasing.
And Mel, your capital investment in new products has been in the range of 2.2 million to 2.4 million a year. Can we expect to see this maintained for the foreseeable future? And is there any shift in the projects that are likely to be deployed going forward?
Yeah. So the level of investment has been fairly consistent over the last 6 years, and we expect it to pretty much remain broadly in that range for the foreseeable future. I suppose what has really changed at least over the last 12 months in particular, is like what we're actually deploying the capital on. And that's now focused more on client-facing solutions, automation, and AI capabilities rather than just sort of focusing on our foundational tech, which is where we, in the first couple of years of Martin and I being on board has really been about rebuilding the technology to allow us to be more open and to scale. And now we're at the point where, we can focus a lot more on building new innovation for our clients and making sure that we can solve their business problems and be more innovative for them. So that's really where our focus lies now. Obviously, we'll continue to upgrade the platforms as required and add new enhancements, but we really do want to meet the evolving needs of clients.
And are there any particular solutions that your clients are looking for that we haven't heard about?
Look, I think the solutions that we deployed and I suppose soft launched and hard launched over the last 12 months are really where the focus on is. So these client-facing solutions to allow them more control. So more tech-enabled solutions versus, some clients don't want to use our managed service, and look, plenty of clients want that bespoke, handheld support from our sales team. But a lot of clients, like with, smaller budgets, want to be more in control of what they do. And so we will continue to enhance the solutions that we've rolled out, Data Rubico, the Insights Creator, and the sample only tool there. And we'll continue to listen to clients, get feedback on board and make modifications as we move forward. So it's going to be really based on what the clients need and want. And it's still early days. Like, there's still new solutions for us. We're still learning. We're getting a lot of feedback from clients. So we'll continue to listen to them.
And Martin, just finally, you have put aspirational targets out there for 2026 and 2027. Perhaps you could just talk a little bit about how you see the business looking in a couple of years' time once you've reached those targets.
Yeah, thanks, Finola. Look, it's more of the same, but much bigger. I think that you can already start to see us as an organisation, how much we've changed in the last 5.5 years, and you can really start to see that coming through now. And that's what clients are getting, investors, sorry, are getting excited about. So they can see rest of the world overtaking ANZ. So if I look to the future, US will be our largest revenue source, followed by UK, followed by Europe, followed by Southeast Asia, and then ANZ. And that's going to take a bit of time to get to, and the stages will naturally be US, UK, and then ANZ. So that's one thing that will happen. Another thing, we'll continue to see EBITDA margins expand. So we're looking at 10 to 11% is in our guidance this year. That's up to 20% expansion on last year, where we had 9% EBITDA margin. Now, for a company that's still investing and still growing, that's great to see. We will continue to see that expansion. And that comes from both operating leverage coming through the business and being more efficient, running our business better than we do. When I look at platform, I think we will see platforms certainly move towards 50% of our revenues, whereas at the moment it's sitting around 22, 23%. So we'll see that increase. And then also continue to see data revenues increase. So at the moment, majority of our revenue still made up of surveys, even though clients are starting to access data. And we will see that actually the other solutions that we have and the data solutions that we have will actually take a larger percentage of our revenue. So what do we end up looking like? It's global company, tech-led and data-led. And that's the journey we've been on. And that's what you can start to see coming through the business really now.
Well, thank you, Martin and Mel, for joining me today to discuss Pureprofile's H1 FY26 unaudited results. I'm looking forward to catching up with you through the course of the rest of the financial year to discuss your progress.